In this example, we're going to look at using the effective interest method when calculating interest payments. Previously, we have looked at the straight line method. So we're going to start. We have Danner Company. They sold $500,000 of 8% 20-year bonds on April 1st, 2014 at 105. So we know that our issue price is $500,000 and that our face interest rate is 8%, and we have 20-year bonds and they pay semi-annually. So we're looking at 40 interest payments. And they were also issued at 105, which means they were issued at a premium, because anything over 100 means they're issued at a premium. The market interest rate is 7.5%, and that's the part that's new. The market rate becomes important now in the calculation of bond interest expense later on. So the company's fiscal year ends on September 30th. So we're going to look at part 1. It says with regard to the bond issue, how much cash is received, how much is bonds payable, and what's the difference between A and B. Now during the issue, there is no difference between the effective interest method and the straight line method. Those calculations remain the same. So for a bond issue, we have to calculate cash received, and we take our face value times the premium or the discount amount, which in this case is the premium. So the face value is $500,000 times 1.05. Now bonds payable is always going to be the face value amount, which in this case is $500,000. And then C, the difference, if the bonds are issued above par, which is above 100, then the difference is a premium. So in this case we have a premium. Now if the bonds are issued below 100, like say the issue is 97 instead of 105, then the difference would be called a discount. So in this case, cash received is going to be our $500,000 times our 1.05. So we're actually going to receive $525,000 in cash for these bonds. Now the reasoning is because our 8% is higher than the market rate of 7.5%. So individuals who are going to invest in bonds will choose ours because they're going to receive more paid out in interest. So because they're going to receive more paid out in interest, they're willing to pay a premium for these bonds, which in this case is $25,000. So bonds payable again is always for the amount of the issue price, so that's $500,000, and then the difference is $25,000, which in this case, because it's a premium, we're going to put it into an account called unamortized bond premium. Now let's begin looking at the payment of interest. Now this shows A, B, and C, but we're actually going to go A, C, and then B, because what happens in the effective interest method is it's easier to calculate interest expense before we calculate the amortization, and I'll show you what I mean. So the amount paid in cash, the amount of cash paid in interest is the same whether you're using the straight line method or the effective interest method. So it's going to be face value times face rate, which in this case face value is $500,000 and the face rate is 8%. In part C, we're going to calculate interest expense. Interest expense is now going to be calculated by taking the carrying value of the bonds times the market rate, and I'll show you how we're going to do that. And then we can go back and calculate part B by taking A minus C. So let's do that. So in part A, 500,000 times our face rate of 8% times our 6 over 12, because we're paying semi-annual interest, so every 6 months out of 12 months we're paying interest. So the cash paid in interest will be $20,000, and that'll end up being a credit to cash. So then let's jump down to part C. Part C is going to be our carrying value times our market rate. Now our carrying value, because we have not paid interest yet, is going to be the amount of cash that we received. Because carrying value when we're dealing with a premium will always be our issue amount of $500,000 plus the balance in our unamortized bond premium account, which we noted up here to begin with was, well, on the previous one, which was $25,000. So face rate plus bond premium is our carrying value, then times our market rate, and then times 6/12 gives us our interest expense amount. So then what happens in part 3 is we're going to do the same thing, only unlike the straight line method, the amount of interest expense and the amortization is going to change. Cash paid in interest is calculated the same. Interest expense is still carrying value times market rate, which in this case, since it's our second time to pay interest, we have to recalculate our carrying value. So our carrying value now becomes our previous carrying value minus the previous amortization. Now that's only for a premium. If we were dealing with a discount, it would be the previous carrying value plus the previous amortization, and I'll show you why. And then B will be just the difference between A and C. So cash paid is the same, 500,000 times our face rate times 6/12. Interest expense, then we now have 525,000, which is our previous carrying value, minus the $312.50, which is our previous amortization, times our market rate times 6/12. Because what's going to happen to our carrying value over time, whether it's the premium or the discount method, is our carrying value at the end of our, what do we have, 20 years, at the end of 40 payments, our carrying value should equal our face rate of 500,000. So since in a premium our carrying value is greater, we're always going to subtract out the previous amortization amount. Whereas in a discount, which you'll see on 9B, we're going to always add it in order to get us up to that 500,000 or the face amount.